Special situations, as popularized by John Greenblatt, is an investment strategy that is dependent on a specific corporate action or external event to generate alpha. To put it in layman words, this strategy involves identifying an opportunity that has come due to external factors rather than the underlying business by itself. For example, there are multiple kinds of special situations like spin-offs, mergers, warrants, buybacks, etc. But today we are going to discuss about one such special scenario called forced selling. Deepak, can you just please explain what is forced selling? What factors will influence this particular outcome, and preferably with some examples, please. Deepak, you are on mute, please.
Yep. Okay, so forced selling, I mean, we have already write an article about this, but there's a lot of conceptual understanding of forced selling because people in the industry know it in different ways. I'll give you an example. I think it was so there are multiple reasons for forced selling. I'll give you one of the most common examples. Perhaps was Z. The shares of Z. Let me show you the chart. I think we can possibly uh, see that chart and appreciate how crazy it was. And I'm not sure if I have the right chart, but okay. I think it was Z or it was Dish TV. I don't remember per se. Uh, Z shares sold. Okay, let me just try and remember the time. I think it was a bunch of pledges. So what happened there was a complex thing, but essentially shares were sold by people who held them through a pledge. So one of the reasons why this was complex was so let me just see. He was sold by I think Nippon Mutual Fund, or at that time it was called Nippon AMC, and or it was Reliance AMC. It was
RNAV.
January something. I can't remember when it was.
Jan
Um,
17, I think.
Jan
No,
2017.
not in 17, sorry. It's Jan 2019. Jan
Yeah.
Feb 2019. Yeah.
Jan 2019. Here you go.
Yeah.
So you can see this daily chart, and this particular day is 25th Jan 2019. So Z was, well, it was not coasting along, it was having a tough time. It has fallen off its all time high from 640 levels. So the stock had gone to 620 in 2018 and then had corrected quite substantially. What happened to us, and let me just make this smaller so that you can see it better. I hope you can see this better. Okay, so this is September 2019. So I'm going to keep going back. What happened here was there was a huge volume here, as you can see. This was roughly uh, 26 billion, so 2,600 crores. What happened in one day that Z, which normally traded 200, 300, 500, 800 crores, was trading at in one fell swoop and fell as much as 26% on one day. The reason was the promoter of Z. Z is a listed company, but it does not have any debt. Its promoter, the Subhash Chandra family, the Goel family, they owned a truckload of shares, and they had pledged some of those shares as part of a deal with mutual funds to borrow money for their own promoter companies. The promoter companies were called SL. So, like in SL World and all that stuff. So SL was the this particular promoter company that owned a bunch of infrastructure assets, roads, bunch of things. These companies defaulted to the mutual fund. The mutual funds took over the shares of Z and sold them in the market. They sold them at any price. They didn't care because they had to recover whatever money they could, and they dumped the shares in the market. These shares were dumped so hard and so heavy that the stock fell 26% in one day. Of course, it recovered a bit, it went back to 477 and all that stuff. But after that, it fell more because there were more drama associated with this forced selling. Eventually, the Goyals were left with just 3 or 4% stake in the company, and that took the share price even further down because people were like, okay, what's going to happen to this company? Through 2020, of course, this was the pandemic. The lows of the pandemic were 116. People were apparently watching TV, so stocks started to return to favor. Z started to do well. Remember, it's a no debt company, but yet because of the high float in the market and continuous selling by a lot of people, the share continued to languish and continues to be in rough places. So now Sony has taken over. Sony has merged itself into Z, or Sony's India business has merged itself into Z. And yet the stock is sitting there at the 250 level, way lower than when that first selling actually first started to happen. The first selling came on the back of pledges. Pledges like this have affected a lot of companies. Even IDFC First Bank, I think the CEO had a bunch of shares which he had taken against his options. So he had converted his options to shares, taken a loan from the bank, and pledged the same shares. When the stocks of IDFC Bank fell, these banks, after the stock falls, your value of the stocks you own as collateral falls. So the bank will say either you top up by putting in more money, or let me sell. So, or give me more shares. Now he didn't have any more shares to give. So what happened was they took the entire shares and dumped 50% of them in the market. When they dumped them in the market, two things happen. Firstly, when you sell into a market that's anyway going down, the shares will go even further down. So stocks fell like 10-12% at the time. But also that a bunch of other stocks fell. So a bunch of other reasons that happened was speculation that this CEO is now leaving the bank or whatever, because they're like, oh, he sold his shares. But he didn't sell his shares on his own. It was forced selling because the guys he had pledged it to effectively sold their shares. The second reason why you might see some forced selling is like in a model like let's say, I'll give you an example. It's like Nika, for instance. Nika is okay, this is an adjusted share, but you're still seeing this bonus issue. And even before the bonus issue, the stock was weak. Like a bigger example is delivery. I mean, this is a 6-month lock-in expires. In that 6-month lock-in, it's not a 6-month lock-in just as an expiry for current shareholders. I mean, it's also for pre-IPO shareholders. Pre-IPO shareholders were locked in for 6 months. These pre-IPO shareholders consisted a lot of VC players. Now, when you go to VCs, they say, well, give me money, and the VCs give you money and say, when will you help? When will you get us an exit? So, well, we'll go IPO and then you can exit. The IPO happens and then they're locked in for 6 months, and then they say, okay, now we're done. The lock-in's opened up. We need to return our customers' money, so we will sell this share. So they might have bought delivery at like 5 rupees or 10 rupees per share. So for them, selling at 375 also is great. So the stock goes to 560. Which is roughly the IPO post-IPO price listing, and then dramatically drops all the way to 341. In this time, you're actually seeing that price has dropped not because of anything else, but because of large amounts of selling, mostly by institutions who needed to get out in order to pay. So they don't care about price; they just dump. So this forced selling happens because of one particular investor having a different reason. Now today's example is GMM Pfaudler. GMM Pfaudler today has fallen like this. This is I don't know how many percent is it, but 15%, 14.5%, because it's fallen to 1644. In fact, it because one of the promoters is a PE fund. 3 years ago, this PE fund did this. Not 3 years ago, 2 years ago. Let's go to 2020. So what happened here was that the promoter did a massive offer for sale. The promoters own 75% of the company, 25% of the public. One promoter, which is DBAG, which is a PE fund in Europe, sold 25%. It's half. It owned 50%. The Patels own 25% roughly. So of that 50%, he sold half. That is, they owned about 25% of the company. And in a complex transaction, they were left with some, I don't know how much they sold, but effectively they were left with 31% of the company. This uh, deal effectively, said that, oh, we are done with liquidity, we're locked in for 3 years, and now DBAG may be in trouble or maybe just wants liquidity out again. So this is after the bonus. We haven't adjusted this stock for the bonus, but the stock again fell from 1,900 levels yesterday to 1,644 today. This is again a forced selling, because I don't think the promoter here wants to sell because there's something wrong with the company. I don't know if that's the case, but I don't think it is. But if it is not, that means their investors are saying, listen, we gave you money. When are you giving our money back? And they say, oh, we have this Fodler stake. Let's sell it. So dumping that Fodler stake and getting out. Effectively, now the Patels own 25% of the company, 75% of them is the public. We don't know who has bought it. We'll only know at 5:30 or whenever the news comes. So GMM Fodler is, well, it's not split and bonus, but just say, if you look at the shares, you'll see a lot of articles that talk about GMM Fodler shares worth 2,200 crores have been sold in a large block deal by the promoter, which is the owner of Fodler. Fodler Inc. was a German company that owned a stake in GMM. About 2 years ago, GMM ulta-fied the transaction. Now GMM owns Fodler, but the owner of Fodler, which was this DBAG, a PE fund, effectively owns stake in GMM Fodler India. So now the stake has reversed things, and now this PE fund is starting to exit. What's worrying is, of course, they're exiting in such a large amount, but it's forced selling most likely. It is not something that they were looking and saying, oh, no, we should sell. We can, maybe they do want to sell and they want to, wait it out. This is the second part. The last one.
On similar lines, Deepak, is Gland Pharma also comes under forced selling? Like Fosun Pharma wants to sell irrespective of the...
Yeah, the wants to sell is not forced selling. The wants to sell is speculation.
Okay. Like you have to sell irrespective of... that comes under forced selling.
Because in DBAG's case, it might be that since they're a PE investor, their customers may be saying, give us our money back. And they want to sell and get the money. But what if here it's less forced? The pledge is more forced, right? Because in GMM Fodler's case, DBAG could have said, I will hold it for another 15 months or 10 months or whatever. But they decided not to, and so there is a decision involved over there. It's not entirely forced, but it could be part of a forced selling exercise because they have to. Now, another thing, for instance, happens a lot is forced selling because of indexes. You look at an HDFC, share. At some point, HDFC, well, it's doing well right now, but there was a point at which once it was known that HDFC would merge with HDFC Bank. After that, the stock first went up and then it started to go down because people said, oh, you know what? All these index funds own HDFC. If HDFC is going to merge with HDFC Bank, first they're going to remove HDFC from the indexes and then bring this thing back. So right now we don't have a perfect example of this, but where can I see this happen? So in index selling, it's basically when the stock goes out of the index, you have index funds who have to sell no matter what. So one big example will be Yes Bank. So in Yes Bank, you saw, for instance, right now, I think Yes Bank is at 21 rupees 20 paisa. This is after a big increase recently. But if I go back in time and I go back to the time in April 2020, what had happened over here was that the stock first fell to 31 rupees. And on the day that RBI announced, this is the day when RBI announced its big thing, resolution plan, they said, oh, there are 255 crore shares of Yes Bank. This will increase to 2,500 crores, so 10x increase. So there's a massive dilution. Those 2,500 crores of shares will be financed by other banks, at least half of them at that time. They said half of them will come from other banks who will put 10 rupees per share. So they added about 1,250 shares first, and then they added another 1,250 shares later. This will add 25,000 crores to the bank, because 2,500 crores more shares at 10 rupees per share, 25,000 crores. That will help wipe away a lot of the losses of Yes Bank. Hearing that news, the market went up. But then there's a bunch of selling that happened after that, because immediately after this, what they said was 75% of these 255 crore shares, plus whatever the banks are buying right now, which is 1,250 crore shares, are locked in for 3 years. The remaining shares can be sold. So 2020, the lock-in started, and the shares will have been kept locked. 75% of those shares have been kept locked. Of course, now more shares have come and all that stuff, but roughly half the shares are continue to be locked. Now, what's going to happen most likely, and we're at 2022, is we are seeing the stock go up here. But I think when it comes to, let's say, a March, there will be a lot of force selling. Why is there a force selling here? Index funds in March 2020 owned Yes Bank. So I can actually show you how. For instance, an SBI mutual fund monthly portfolio. If I look at the monthly portfolios of SBI mutual fund, this is a small example, and I'll show you how this works. Okay, here you go. Let's see if we can get to other schemes. Nifty, not the index fund. I want the Nifty ETF. Here you go. And I want the 2022 November. Yeah. So I'm going to submit this. What it will do is it will give me, it should give me, well, is it not giving me anything? Maybe the November portfolio is not yet live. So let's go to October. Why are we not getting this? Okay. And October and submit. Am I doing something wrong here? There used to be some shares. Bank is closed now. I love it. The statement needs to actually be lunch break on the website. I love it. Yes, this is brilliant. So I wonder why this is happening. It was working till yesterday. Let me see why this is happening. Hang on. Maybe it's because of my ad blockers. Okay, we're going to do a lot of turns, and then we're going to go to other schemes, Nifty ETF, 2022 November or October, and we'll hit submit. I hope this works. Well, it does not. So I am going to I'm going to go check my downloads folder for portfolios, and I think I have the portfolios. Okay, I do. So I will just share a different screen because I have this portfolio with me. Hang on. So this is a quick thing here. We'll just stop sharing this screen and present a different screen, which is this one. Okay, I hope you can see this. This is the Nifty ETF. Okay, this is the largest Indian mutual fund. It has some 1 lakh, some crazy number of, I don't know how many does it have. How much does it have? We'll see soon. 1.58 lakh crores in AUM. This is this is the largest single fund in India. So this fund actually has a bunch of shares. You can see that it has, ICICI, Reliance, all of this stuff that in different proportions. But it also has somewhere down below something called a reconstituted portfolio, Yes Bank Limited, which is 2.36 crore shares. 2.36 crore shares is not a lot. It's only some 40-50 crores in AUM. Okay, it's not a huge amount of money. But this 2.4 or 2.5 crore shares are marked at a value of 0. And you can see the thing to it. It says, well, let's see if it's written something. Well, it's not. It's not. Okay. So essentially, this is locked in note on Yes Bank. The 75% on if Yes Bank has been held here. Any realization? Okay. Any realization of value after this will be actually shared with only unit holders who are impacted due to the 75% locked in. So a new buyer may not get this portfolio, but the old buyers will. So essentially, on the day that this expires, which is 13th March 2023, this particular fund has to dump these shares on the exchange. So that means we will actually have a situation where you will no longer be. I mean, you don't care about the fundamentals of Yes Bank. It's getting better. It's not in the Nifty 50. I have shares of it. I have to dump it. That is what will happen exactly on the 13th. You cannot wait, because SEBI says if you're an index fund, just perform according to the index. Don't try any stunts. Which means that on the day these shares lock in open, they will dump these shares. This will happen. This is another case of forced selling. The last one is in case of mergers and acquisitions. So what happens is demergers. If you have a demerger where one stock demerges into another, but you bought the business because of one particular business. So maybe you bought a demerged company like, I don't know, APL Apollo, or not APL Apollo. I think APL Apollo merged. There were a bunch of other companies where you saw a demerger of the core business into multiple other businesses, right? So you've seen this happen in multiple things. There was a company called Aditya Birla No. There was a company called Grasim. They merged and then demerged into Aditya Birla Capital and Grasim. So if you bought Grasim for the cement business, and therefore now as a part of this demerger, you also get shares of AB Capital, and you don't want to own AB Capital. AB Capital is a Aditya Birla Capital company, and then you will just dump the shares. So if you look at AB Capital as a company, this did not have an IPO. This was just Aditya Birla Capital, the finance company and the holding company of the AMC. This was forced selling from the minute they. So this is the listing. The day that it was demerged and listed. After that, people dump. So this dump was a large amount of it was people who had bought some of these companies as on account of their Grasim exposure to cement. But they were like, why are we getting a capital company here? Even if I'm getting it for free, I don't want it. I'll sell it. So you sell it for whatever price. Of course, it's not yet reached that price since then. But this price, as the price got dumped quite quickly after the listing of the stock after the demerger. So I think that is another form of forced listing. Oh, sorry, I did not share my screen. I always share my screen, and now I don't share my screen. So this is Grasim. This is Aditya Birla Capital. It listed around 2017. So the share got dumped a few days after the listing, almost consecutive lower circuit. So if you see it here, you can actually see only one price, which is just lower circuit. That means the stock trades at the low of the day and cannot go lower because of the lower circuit, and therefore there's only a dash. That dash was for 3 consecutive days, and after that you saw some rise, and then whenever there was huge volumes initially. After the dump, the stock recovered. It took some time. Of course, it's still not recovered. It's not like it's recovered. So it's sitting today at 152. After 5 years after it has listed, it's still 40% below the first price that it showed after its demerger. So a lot of that forced selling just took a lot of the wind out of the stock.